Welcome to the Broken Pie Chart Podcast, episode 306. I'm your host, Derek Moore. Jay, as we mentioned last week, is going to be off a couple of weeks, but plenty to talk about. I'm going to have some other guests on as well next couple of weeks, at least for January. Plan right now is for Jay rejoin as he's now semi-permanent co-host because he's missing some shows here. All right, first off, we're not going to do a 2024 year in review. I hate those. Like, we've been talking about the markets all year. There's no reason to go over what you all know already happened. So, done. Not happening. I do want to talk about don't fear pullbacks, don't fear declines, though. And I went back and I looked at some of the numbers. And look, I mean, we didn't have the Santa Claus rally. We didn't have the after Christmas. Market keeps going up. I know Tom Lee, and he's been right on valuations or the levels of the S&P for a while when a lot of people were bearish. He thought maybe it could get up to about 6,300. Didn't happen. We'll see if that happens this year. But I went back and I looked at some data and annual returns and intra-year declines. And I'll go and put these on the ZegaInvestments.com. We'll post it as a blog. When I know most of you, obviously listen to this, but sometimes, you just want to see some of the visuals. We had that feedback from a lot of audience members. So I'm trying to put stuff that I'm looking at and talking about, and Jay and I are talking about, into the follow-up in the Zega Investments blog. So pulled some data. JP Morgan Asset Management, they have a guide to the markets. Also pulled some data out of Bloomberg. And I mean, here's the thing. Don't fear intra-year declines. Don't fear pullbacks. They happen a lot. They're perfectly natural. A little bit later, I'm going to talk about valuation and forward PE ratios and forward earnings estimates and how those move sometimes together and sometimes they deviate. But 2024, minus 8% was the pullback. Market closes up about 23% rounded. 2023, market was up 24%. Intra-year, so this is the intra-year decline. It was down 10% at one point. Rallied up. 2022, market finishes minus 19%. These are all rounded, and I believe these are total returns. Market at one point down 25%. What is that? 2021, pullback of 5%. Market closes up 27% for the year. 2020 was a screwy year, but I mean, it's down 34%, wound up closing 16%. That was the nutso year. 2019, up 29%. Intra-year decline, 7%. So you'll see, I'm not going to go through all these, but the point is you shouldn't necessarily panic if you see an intra-year decline, if you see a pullback. Emerging markets, by the way, if you look at some of them, I think they're almost in quote-unquote correction territory. I think at one point they were getting close to 10% down. The S&P obviously hasn't been doing that. But, it's pulled back from the high, although it did have a very strong day on Friday, kind of hit some support levels. We'll see if those hold, whether maybe they fill the gap still, but I'll let you know when you know. When I know, I'll let you know. Well, we'll all know. So 1987 is always my favorite to look at. Market was down 34% and it closed the year up 2%. A lot of people forget that. 1987, the worst single day probably. Certainly, for anybody who's been in markets for a long time. And really bad couple days, but the market actually winds up finishing positive for the year. So this is the S&P intra-year declines versus calendar year returns. If you look and you say, well, what's the average pullback? So let me see, who posted this? This is from, who posted this? This is from Carson and Wide Charts. So putting 2024 in perspective, the pullback in 2024, excuse me, they have minus 8.5% on this data. This is again from Wide Charts. They say the average since 1980 is minus 14.2%. That is the S&P 500 index max pullback per calendar year. Max pullback per calendar year. So maybe a little bit different way of looking at the data. And yeah, I mean, you look at these, sure, 2008, we were down, 37.5%, 38%. At one point, we were down right around 50%. And, of course, the market still closed down. It's, the worst day on here since 1980. 87 is the one, down close to 40%. And they close up 2%. Mentioned those before. So I just go over this, and I think to put it in perspective, and this is why we like the idea. We've been discussing for a while how in some of our foundational things that we look at, our buy and hedge methodology, we actually rolled up protection coming into the year. So, if you want more information on that, Derek.Moore at zegainvestments.com. That's DEREK.MOORE at Z as in zebra, E as in Eddie, G as in George, A as in Apple. Investments is up to you to spell correctly.com. So shoot me an email. I'm happy to. And you can go on our website, zegainvestments.com, and see some of the strategies. Okay. So that's one of the reasons why we just like the idea of buying and hedging. It's a core philosophy, and it lets you stay in the market, but then you have this different types of protections or buffers, depends what, which of the strategies we're doing. But it just makes sense to me because we don't know where markets are necessarily going to go. And I'll get to the valuation kind of point that I'm triangulating towards in a second. We just don't know where they're going to go. So why not be hedged? If the markets run up, great. Get a nice amount of that. If markets really tank from here, you have some protection in place. So I'm a big fan of that. Anyone who's read the Broken Pie Chart book knows I have a whole chapter on why diversification fails. And I went back and I looked at 2008, 2009. I looked at some different periods where everything was down. So I actually prefer hedging as far as that goes. Let's talk about valuation, though. Oh, you know what? There's a visual capitalist posted one of those stack charts where they have all the years, and they kind of said, okay, 0 to 10%. List all the years and stack them, all the years. And this gives 151 years of markets. Okay. Well, the S&P technically started in the 50s, although there was an S&P that goes back much, much further than that. But okay, they did 151 years. Good for them. And they have these bins where they say, 0 to 10%, 10 to 20%, 20 to 30%. And 2024 was in the 20 to 30%. The most often is 10 to 20 if you sort of stack those according to they list them. So I'll post that in the what do you call it? When I post the blog article, I'll post this one as well. I'll try and remember to do that. But I want to get to the idea of the valuations. And this is important because the forward PE ratio actually came down. So the forward PE ratio is basically just what are the expected earnings over the next 4 quarters, next 12 months, and then what's the S&P 500 at? And you divide the S&P 500 divided by the earnings per share estimates. Those are estimates only. Those can change. They often do. And you get the forward PE multiple. It's the price divided by the estimated earnings over the next 4 quarters. And when I pull this most recently, what do I have? About 22.56. I think it had gotten up close to 23. And earnings estimates are anywhere from 263 to 271. But here's why I bring this up. You can have earnings estimates go up and the multiple go down. That's actually what we saw when you kind of go back. I'll put these in the article as well on the Zega Investments blog. These are from Bloomberg. Liz Ann Saunders had posted something on Twitter. I liked it, so I said, I'm going to recreate that. She posted a Bloomberg screenshot. So thanks to Liz Ann for giving me the idea. And what you see is, 2020 earnings estimates for the next year. Earnings estimates for the next year. And so think about it. Like, what are the earnings estimates for the next 4 quarters right now? And then a month from now, those estimates could be different for the next 4 quarters from there. Well, I guess it's still the next 4 quarters because we're getting to earnings here. But 2020, we had PE earnings estimates plummeted. We all remember 2020. And PE ratio, forward PE ratio shot up. I think at one point it was almost 26 times forward earnings. And then what you see is the multiple started coming down. In fact, the multiple was in a downward trend until I'd say mid-2022. At the same time, forward earnings expectations continued to rise. And what we've had really since the bottom in 2022 is earnings expectations are going up over the next 4 quarters. And remember, in 2022, the next 4 quarters incorporated different periods than the next 4 quarters from now. Hope everybody understands that. But then you look and you say, well, the multiple has been and there's been ups and downs, and it's not been a straight line up, but generally it's been trending higher. So we've had earnings expectations going up. We have forward multiple going up. And when you have those two components, the price of the S&P is going to really go up. That's how we got these back-to-back, very, very strong returns, because the multiples going up, earnings expectations are going up. Put this in perspective. Let's say that we stuck at about a 22.5 forward multiple now, but earnings expectations drop 10%. Well, all else equal, if we're still trading at 22.5 times and earnings expectations go down, well, the market would have to come down for that same 22.5 forward PE to be in there. So I just think you always want to remember, in the end, earnings really, if you do a chart of earnings growth and you do a chart of the market, I mean, generally over the long term, that's going to be kind of important. Right now, the earnings expectations are still pretty strong. In the next couple of weeks, we're going to get into earnings season. It's happening again. That will give us another look at companies. And it also helps to understand what the forward expectations are going to be. That's the time that CEOs come out and CFOs, and they do their dog and pony shows. And they're going to come out and they're going to say, well, here's our guidance for the next quarter or the next year, those types of things. And although NVIDIA is late in the earnings cycle, I forget when they go, usually they're towards the end of the earnings cycle, that's going to be a pretty big deal. Although TSMC, Taiwan Semiconductor, is I think they're in the next couple weeks. So they make a lot of the chips. So that's an interesting one to take a look at. So if you look at longer term, look, 1995 to 1999, end of 99, very beginning of 2000 is sort of when the tech bubble crashed, and the NASDAQ cratered. S&P wasn't as bad, although the S&P had 3 consecutive down years, which is pretty rare, 2000, 2001, 2002. The forward PE ratio got to around 26, it looks like. And this is a quarterly one, so it's not daily. It may have been higher intraday, or not intraday, on a daily basis. But when you go back further and you get more data like this, a daily chart just becomes too cumbersome. But what you saw in 1995, 1999, earnings expectations were going up, but the multiple went up disproportionately as much. It went up much more compared to how much the growth in earnings expectations. And you get start in 95, the forward PE is something like 14. It ends 1999 at around 26 times forward earnings. So you get the multiple adjustment. So the reason why I spend so much time on this is, remember, in the end, given the choice, you'd rather earnings expectations continue to go up, because if the market decides, hey, we don't want to be at a 22.5 forward PE, we want to be in a 21.5. Okay, the market's going to pull back. But in the end, you want earnings expectations to keep growing, because then the multiple sort of backfills and gets you to the price. And to think about this, when you look at the S&P 500 index and you're kind of saying, okay, well, what is the, where is the market trading right now? A change in the multiple is pretty significant. So 22.56 times, let's see, if we use 263.38, that gets you to a S&P of 59.42 rounded. So then you say, okay, well, what if those earnings expectations don't change at all, but we go from a 22.56 to a 21.56? Well, then the S&P would have a price of about 56.78. So you kind of see what happens there. A little change in the forward multiple can actually change the price a lot. So those two things can change. What we've seen, though, yesterday, volatility stayed high through the end of December. If you look at the VIX, you look at the VVIX, it ended under 17. But what we'd been seeing coming into the holiday season or the beginning of December, is the short-term volatility was so low. And now we've seen that pendulum swing a little bit, where if I look at something like the 9-day VIX, that now is probably a little bit higher than, or at least it was, it may have come back in. That was on par with maybe the 30-day VIX, the spot VIX that you see on TV, not the futures. So those are all things that I'm kind of keeping a look at. Hopefully, I'll post those on, and I'm always fascinated. I always have been when you think about over a decade, what is the driver of returns? Is it a change in margins, change in sales? Is it a change in the dividend payout? Is it a change in share buybacks? Is it a change in the multiple? And margins, I will tell you, are forecasted. Thinking about the forward, 12-month margins, those are still above 13%. Meaning, if you sell $100 of stuff and you make $13, it's like for every $100, 87% or $87 goes to cost. $13, let's say, rounded. Well, I should say that's about 13.7, but $13.70 is your profit, and everything else is your cost. And we've seen, that's been one of the things that have confounded, especially the argument for going into value stocks versus large cap US equities, which of course is very tech heavy right now, is the idea that you're going to have this reversion in margins, but we haven't seen it. Margins are still, if you look at, for example, JP Morgan's guide to the markets, they had an interesting chart. They looked at the Magnificent Seven. You all know who the Magnificent Seven is. And they looked at profit margins of the Magnificent Seven, and they looked at profit margins of, let's say, everybody else. So the S&P X Mag 7, 9.3%, which still would be really good. You go back into the 70s and the 80s, and profit margins may not have even been there. The Mag 7, though, in third quarter of 24 had a 23.5 net profit margin. It's really, really strong. When you look at earnings growth, and they have a chart, pro forma EPS estimates, fourth quarter 24, so that's what will be coming out soon. Year-over-year growth. Q1 2024, Mag 7 estimates say 50% year-over-year growth. Everybody else minus 2% year-over-year growth. Q2, plus 35% growth in EPS, earnings per share, year over year. So when we say year over year, it's like Q1 of 24 versus Q1 of 23. And then you sort of look at estimates. So those actually already happened. But then so now we look at estimates. So fourth quarter. Hopefully I didn't misspeak and say that. Actually, I did misspeak. Let me clean that up. Those were actuals, because I'm still getting the years. I'm thinking, oh yeah, we're in 2025 now. But Q4 2024, the estimate is plus 23% year over year growth from Q4 23. So Q424 is the one we're going to come out right now. Okay. I'm not going to re-record this, but hopefully you guys are keeping track here. And 23% for Mag 7, 8% for the S&P X Mag 7. So, it's a different index than it was before. It's a different index because it really is just, think about the types of businesses that are in there now. They're higher margins. A lot of them are technology or cloud-based businesses. Like you're not having to go out and buy 1,000 tractors to run your business, or buying a bunch of buildings, or a lot of this stuff is in the cloud. Last thing on valuations I will tell you is that I know a lot of people, you're going to see the charts, and you're going to see the charts that show if you're at a forward PE of X, what's the average return going forward? And I will tell you that, and this is in JP Morgan's Guide to the Markets as well, the forward PE and subsequent 1-year return, they've got a chart. And I will tell you, this is December 31st. They had the forward PE at 21.5. They're probably using their own estimates. My numbers on Bloomberg were actually higher than that. And yes, if you're looking at sort of a regression, you would say, yeah, on average, the returns are a little bit higher. I shouldn't say a little bit. If you're buying at a very, very low forward PE, that's probably better than buying at a higher PE. But I will tell you that on a 1-year basis, these things are scattered all over the place. You have years that are up 40%. You have years that are down 25%. And there's something called an R squared. An R squared is really when you have one variable against the other. Let me try and not confuse everybody. It's like, is the correlation 100%, one variable to the other? That's kind of a good way of, and the R squared 7%. So it really doesn't tell you, the forward PE really doesn't tell you necessarily with certainty where returns are going to be over the next year. Even over 5 years, the R squared goes up to 20%. And sure, I would say again, the chart shows, and I'm happy to I'll take a screenshot of this and put it in. The 5-year forward, I would say, yeah, returns tend to be less from this, a forward PE that's as high. This is why we go into the idea of being hedged, because if you do get a pullback, a substantial pullback, and you got some protection in the portfolio, and you cut out some of the downside there, well, then maybe you don't realize all the loss. Again, you can send me an email if you want to know more about that. We manage, individual portfolios for investors and for advisors and their investors. Okay. The other thing I need to talk about is rates. And okay, so there's an interesting, I'm a technician at heart, and I went and I looked at a chart of the 10-year yield. So this is the rate on the 10-year Treasury bond. And remember, I've been saying, I think, my prediction is it goes to 5.6, 5.7 next year. And I won't rehash the whole reasons, but I tend to think maybe the 30-year mortgage market is more right. And that's not going to revert down to the 10-year. The 10-year, because of growth and because growth expectations, is actually going to go higher. We're seeing the curve already uninverted. In fact, I think as of Friday, and Bloomberg had a chart on this, the 2s, 10s. So if you look at the 2-year Treasury bond, this is the chart that Bloomberg had. I would prefer the 3-month, but 2s and 10s, the 2-year yield and the 10-year yield, the gap between those is the steepest since 2022. It was 31 basis points. So we're seeing the further end of the curve start to steepen. And when I look at a chart just of the yield of the 10-year, it's a little bit cup and handle-ish. So if you can think about this, it's kind of like a cup and then the handle. That's what the chart looks like. And if this was an individual, if this was a market, if this was a stock, you would say, well, if you were a technical trader, you'd buy it on a breakout and you'd probably put a stop or some other protection a little bit below where the resistance becomes support. And if you look at this chart, it kind of says, well, maybe it goes to 5.6. Is that bad for markets? 1995, 1996, it wasn't necessarily bad. But, we'll kind of see what happens there. I will say that when you look at the expectation for further cuts in interest rates, those have come way back now, way back. They do that with the Fed funds futures. You look at whether Fed funds contract is trading in futures months. You do some math and you get an implied interest rate based upon where they're trading those. And the effective Fed funds rate right now is 4.33%. So the target range is still 4.25%, 4.5%. I think that's where we are, right? Yep, 4.25%, 4.5%. And I'm looking at where the implied Fed funds rate is. Remember, I just told you it's 4.33 right now, 4.33%. And it really doesn't apply a full 25 basis point cut until June now. So right now, the expectation is to have another quarter point cut at the June 18th meeting. That's where the probabilities are. And the implied Fed funds rate would be 4.06. That's kind of gets you a full kind of point there. I would tell you that there is not another cut priced in all the way to April of 2026. There is probably a 40% probability of a second 25 basis point cut by April of 2026. And the implied Fed funds rate for that contract, or that April 29, 2026 meeting, 3.92%. So I just told you that 4.33 is the effective Fed funds rate in 1911. So that's 0.41% lower than it is now. They are not pricing in cuts anymore. They're really not. There's basically a probability of 100% of 125 basis point cut by June. These are going to move around. Of course they will. I could go back to October. I could go back, and show you all different ones. But this is sort of the repositioning, and I think the market is sort of grappling with the idea of higher for longer. If they were listening to this podcast, I don't know why Jay Powell doesn't. I mean, we've been telling you for a while that it's likely markets or rates stay higher for longer. We've also been saying it's not necessarily a bad thing for markets. When you have rates going up and the growth expectations are going up, and if earnings keep going up, then, we look at the 95, 96, 97 period when all of those things happened. There was no recession. The markets kept going higher. Look, I don't know what's going to happen with markets, but I can tell you that it's not necessarily bad. And the 10-year going up, remember the 10-year yield on the US Treasury and the 30-year mortgage rate, there's some alignment there. And it gets into mortgage-backed bonds and securities and different things like that. But, the 10-year going up from here may not necessarily cause the 30-year rate to go higher. I don't know. But I will tell you that, I can't tell you how many people that said, who I knew or maybe going to sell a house or buy a house, they're like, oh, I'm just going to wait because the Fed cutting rates. And I said, I'm not sure that mortgage rates are going down if the Fed's cutting rates. We'll see what happens. We'll see what happens there. All right. Want to check back in on the China yield situation, and yields continue to drop there. I think last time I looked, I don't have do I have a chart of it? I'm trying to see if I have this in my notes this week. But I believe the 10-year in China is roughly 1.6. I did not include a chart for myself this week. But so that continues to be something to take a look at. They are easing. Rates are going down. The yuan is gaining strength. There's a sort of a contrarian where you would say, well, if tariffs go up, if their inputs go down and their financing costs go down, they're easing. Does that help them does that help prices not go up here? I haven't fully vetted that yet as a sort of theory, but I'm watching it. The other thing I'm watching is oil. And I don't know, when I talk to strategists, I talk to people, it doesn't seem like anybody wants oil companies. Look, I don't know where oil's going. I don't know where, should you buy oil companies, not buy oil companies? You want to buy them, buy them. If you don't want to buy them, don't buy them. It's up to you. But I will tell you that crude oil closed just under $74 a barrel. This is West Texas Intermediate. It was the highest close since probably October of last year, which is now October of 2024. And we'll see. I mean, I think, I don't know that a lot of people are talking about this, but oil going higher would be problematic for the Fed from a narrative standpoint. And the reason why that is, CPI generally has not been too worrisome for them because really gas prices, fuel prices, all these things, they've been really, just kind of chilling out. They're not really doing too much. They've been lowered. And even if I go back, let me see if I can go back to, prices on crude oil are lower than they were at the end of January right now. In January, they were probably closer to, 77, 78, something like that. So they're basically where they were, maybe a little bit higher at the start of January you know what? I only did this January 5th. I don't know why I did that. I think I did a 1-year chart. But keep an eye on this. If fuel costs rise, and I think inventories were lower than expected, that was one of the things. There's this polar vortex coming, which I don't know if that's why oil's going up. But just watch this. And, sort of the contrarian thing would be something that not a lot of people want and has fallen out of favor. Maybe that's when it really starts to make a run. I have no idea. Again, don't buy or sell it based upon, I'm just talking out loud, and it's something to keep an eye on because it goes back to the narrative for the Fed. If fuel costs go up and if CPI starts to be impacted by that, that's going to really hurt the narrative there. So, all right. Last thing I want to go back to is, got to do it, MicroStrategies and Bitcoin. I know, I'm shocked. Jay's not here and I'm talking about Bitcoin. Well, here's what happened with MicroStrategy. It's now off. Let's see. Its high was 543. It closed the other day at 339.66. So it's off from its high. And what is that? It's off about 38% from its high. And I read in an article the other day, where does it go? Yeah. End of year action was disappointing. This is a quote from, let's say, Yahoo Finance. Well, MicroStrategies, MSTR, fell by 25% in December. Bitcoin fell by only 3%, holding relatively steady above 90,000. So remember what we said, or maybe I said, and for anyone who's playing with MicroStrategies, and if you don't know what's going on, you're probably living under a rock. But the idea is that they essentially are buying and holding Bitcoin, and they own, on a levered basis because they're issuing debt and taking the proceeds from issuing the debt and buying more Bitcoin. And also they are, how would we say this? If the convertible bonds, if they convert into shares, and I'll try and remember, we really detailed this in another episode. So I'll put a link to that rather than going through that again. But if you convert those bonds into shares, the debt goes away, but then you issue more shares, theoretically diluting existing shareholders. And for a while, this was going up more than Bitcoin. Now it's flipped. And as I just read off in December, the volatility, though, it's come down. so the implied volatility. Implied volatility is how the options market is pricing in sort of the expectation of 1, 2, 3 standard deviation moves. At one point, and this is right at the high, the implied volatility on MicroStrategies was 220%. And so basically on a 1-day basis, so you take the square root of 252, although this year we're going to have to do square root of 251 because now we have January 9th as the market holiday for ex-President Carter. But okay, let me do my normal math though. So at 220% implied volatility, square root of 252 is 15.875-ish. It's basically saying 13.86% is the expected, based upon the options market, what it's pricing in for potential movement, about 13.86%, 1 day, 1 standard deviation move. So the implied volatility has dropped on this a bit. It's now, I say, only 110%. So 110% divided by 15.875, the quick math, and it tells you that the options market saying about a 7% 1 day, 1 standard deviation expected move. So it's still really volatile. To put this in perspective, the implied volatility on the S&P 500 is 16. And I would say that that's not its most recent high, but 16 basically is implying about a 1% move, 1 standard deviation, 1% move over a given day, basically is what that's doing. Because the floor traders used to do what's called the rule of 16. They take the implied volatility divided by 16, do the easier math. And so you say if implied volatility is 16, you divide it by 16, it's about a 1% implied move. And where those implied volatilities are coming from is how the market makers and how the options chain is being priced. So if something is expected to be more volatile, that will be reflected in the price of a put or a call. And so, there's no free lunch. So it's kind of saying if somebody thinks it's going to be volatile, the market thinks it's going to be more volatile, it's going to have a higher premium, a volatility premium that's in there. And so MicroStrategies is still a really high implied volatility. Like, I don't know if MicroStrategies is going to outperform Bitcoin over the next week or underperform it. But I just want you to be aware that this is a ratio thing. And good for that hedge. What was it? The hedge fund? I forget the name. They sort of, I think it was right around the high of MicroStrategies. They said they were going to short MicroStrategies and buy Bitcoin. Looks like that's been okay for them. Is that going to be a good one going forward? I have no idea. So I'm not here giving you certainly not giving you advice on MicroStrategies, but just understand the volatility that's in there. And if you're using a trading program, a lot of times they'll have, for example, Thinkorswim. If you're on the retail side of Schwab, they'll have a chart field at the bottom. You can import it. You can put it on your chart at the bottom, much like you have volume. You can have implied volatility, but that's the math. You basically are saying there's 252 trading days in a year, and you're taking the square root of time. So if I take the square root of 252, or if I take the square root of 251, because that's like 15.84, and square root of 252, it's about 15.875 rounded. So it's a little bit higher. And all that does is you take the implied volatility divided by the square root of 252, now 251 because of Carter's the day off for ex-President Carter. You divide it by that, and that's the 1 day, 1 standard deviation implied move based upon the options market. That changes. I just told you that MicroStrategies went from 220%. And when we say 220%, that's the annualized expected volatility based upon the options market over the next year. When I say 16%, that's the 1 standard deviation expected move over the next year. So then you do that math to bring it back to the current day. And by the way, if you want to get really fancy, if I want to say, oh, what's the one standard deviation move of the next 49 days? Well, in theory, you can take the implied volatility divided by the square root of divided by 15.875 times the square root of, let's say, 49, which is, 7. So if a 1-day move is 1%, the 49-day move would be 7%. I'll leave it there. There's actually nuances and expected volatility over different time frames, looking at the volatility surface. But that's it. We're done. Recommendations this week. Jay did not give any to me. He did not pass any along. I watched a lot of the football games, Arizona State. For anyone who watched the Arizona State Texas, I'm sorry if you're a Texas fan. That was the refs missed a penalty, I think. It should have been targeting or helmet to helmet. If that isn't a penalty, I don't know what is. But hey, I live in Arizona, and I was hoping Arizona State won. I have been watching The Agency. I'm trying to remember if I've actually mentioned this one before, but I've been watching that. I think it's got 2 more episodes left. It's a Showtime show, but it's also on Paramount. I can't figure this out. I think they've apparently merged, and so you can get Showtime shows on the Paramount app. Or anyway, I don't know. I still go back to, I don't know why I do this, but I shouldn't start watching shows until the season's done, because I just want to go and binge watch it. And I watched like the first 4 episodes, 5 episodes, and now I got to wait. And I don't like it. So far, though, it's interesting. I don't know. I got to really think about how it ends. I think it's an interesting show. I started watching it, so I'm sort of committed. It's sunk cost at this point. I don't know if it's my favorite, though. I'm not sure. I'll let you know. All right, that's it. We'll probably have somebody else on with me next week. Again, Jay is going to take January off. We'll get the band back together, hopefully in February. And keep the emails coming, derek.moore@zegainvestments.com. Also, continue to send idea. Jay and I are writing a book together, and we got our topics, started writing it, but always taking feedback for things that this audience wants to see in the book. We're going to have some stuff about options. We're going to have some stuff about Bitcoin. So kind of looking forward to that and get the writing going in earnest there. Also, if you're listening to this, please forward it to someone that you know that might enjoy the show. That's how our audience grows. And thank you to all the international listeners. I'm always shocked at some of the countries we have big listenerships in. And it's always surprising and humbling that people around the world are listening to this, or they have VPNs and it looks like they're in some other country. So anyway, I noticed a lot of Luxembourg listeners lately, which is, I don't know where. We used to get this email that would show us where we rank in each of the countries. I think that service got shut down. I don't get the emails anymore. But I gotta believe we'd be pretty high in Luxembourg based upon the number of listeners or downloads, how they do it. So that's it. We're done. Enjoy the week. Enjoy the market holiday, which is Thursday, January 9th. See you, everyone.